Okay, everyone. Thank you as always for joining. Today we have another great retirement planner chat episode. Today I'm joined by my friend Victor Medina. Hello, Victor.
Hey, Andy. How are you doing?
I'm great. Thank you for joining. I've been looking forward to this for a while. You are one of the first people I came across in the industry by finding your content. You had a podcast, Make It Last, that I came across in, I want to say 2017 maybe.
Okay.
And loved it. And I was like, wow, this guy's giving away great information, clearly knows what he's talking about, really thorough, down-to-earth, practical knowledge that I just fell in love with. And I reached out to you just cold. I was some random guy on LinkedIn. It's like, hey, I like your podcast. And I think you said thank you or something like that. So you were kind enough to reply back. But that's how I first met you. And I've since followed you and went to one of your seminars you did not too long ago and really enjoy you and what you do and how you do it. So I was excited to ask you to come on, and I'm very thankful that you're here. So thank you for that.
Thank you. Well, it's a mutual admiration society. I think that what you put out in the world is fantastic as well. I like you personally. I don't usually like other advisors, generally speaking. Like, we tend to be the kind of the people that like, I have an opinion of that person, but you I've always loved. And I think that what you do out in the world is fantastic because so much of the content that you put out, it's really for people to take and enjoy and do great things with it, not necessarily because it's driving your business, and your passion is definitely there. So I'm as happy to be here as you are to have me.
Great. Yeah, I think we're very kindred souls in that sense, right? So it's logical that we met up here. So Now, before we get going, I wanted to let you know that Times New Roman and Comic Sans walked into a bar, and the bartender said, "Sorry, we don't serve your type here."
Okay. Yeah. Good. I like it. And I'm a font guy, so it spoke to my heart a little bit.
Okay. And then after that, a dung beetle walked into the same bar, and he asked, "Is this stool taken?" So, no, yet no.
Now, the reason I like that joke as a setup is because the response, usually in the format, is waiting for something else, but the punchline comes with that. So,
yeah, right.
It's a good setup.
Okay, it's all uphill from here. That was the worst of the show. So let's get on with it. All right, if you can give a quick background yourself, your firm, your business, etc., and we'll go from there.
Yeah, so I am in central New Jersey. I married a Jersey girl, which is how I arrived here. And for the last 27 years, she's been the love of my life. We have 3 boys that are at different stages of their life. One's in college, one's a senior in high school, and the other's entering middle school. So my parole hearing is not for another 11 years or so. And I own 2 companies, I suppose, in the retirement space. One is a law firm that does estate planning, and one is a financial services firm that focuses on retirement planning. I have this third company that I guess is maybe tangentially related, which is I coach lawyers to lead great lives and great practices. So I guess that's related to doing a little bit of retirement planning, but that's kind of what keeps me busy.
Yeah. Now, can you give a little more backstory? So you're interested because you started as a lawyer with the estate planning, then got into the advising part. Is that correct?
Yeah, that's exactly how it happened. So as I began my practice, one of the things that I started in estate planning was actually related to a family member that had something terrible go with their estate planning. They passed away, which is terrible, but then they had something wrong happen in their estate planning, and kind of gave me a view in the way that practice is conducted. And we had an opportunity to change some of that. For example, we really looked at whether or not the documents worked when we needed them, those types of things. So we crafted a different kind of estate planning practice where we had people on a maintenance program where we would do their documents and we would update them. Because we were seeing them on a regular basis, one of the things that we had a view into was how are their financial lives going? And a couple of things came out of that. One was clients that were liking what we did, asking us whether or not we could help them in that area. And for a long time, I kind of put my hands up and said, no, that's not what we do. But the other thing that got me over the hump was we would see them come back with plans that we had crafted and advisors that weren't doing the right thing. And I don't know the reason for that. Maybe they were just not knowledgeable. Maybe they were not interested in doing what was right for the client. But we had an opportunity to come back and do the right thing for them. We thought it was kind of an obligation of ours to get it done the right way. And so about 10 years ago or so, I went out and got every credential that I thought was available. I was trying to overcome a lot of imposter syndrome with having a lot of letters after my name. So I went out and got a bunch of different, designations. And from that, launched a separate financial services firm and really focused on the clients that we had been seeing in the estate planning. I mean, you would understand that estate planning people, most of the time, they're doing it in connection with kind of their retirement plan. They're finally facing their mortality. They realize that it's going to be an eventuality that they're going to pass away, so they ought to act like an adult. So we're seeing them around the same time, and so it became a natural extension to kind of bring that all in-house and then see our clients holistically, kind of just from the entire spectrum right around that age when they retire until they pass away.
Great. And I know you do have proper office space. You have a really nice like educational teaching facility or space above your office.
Yeah.
With that said, so obviously you see clients in person, but do you have any virtual presence as well with either of your businesses?
Yeah, so it's interesting. I think the shift over to COVID really accelerated our virtual presence and the ability to work with people virtually. I've got clients ranging across the United States that have come out to us, I think probably because some of the content that we've put out there, but also some referrals that have gone across. Can you help these people? And check the registration requirements. If I got to file something in the state. But, we've seen people in Michigan, Florida, Louisiana, and we've really kind of built out a robust service model for people that don't necessarily want to come into the office. So kind of take them the way that they come. And we certainly see, I would say, the majority of our clients in our office, but there is a good smattering, and I would be guessing at the number, whether it's 10% or 7% or something like that, of people that we see virtually as well.
Okay. And just last question about the practice. So you are one of the larger firms or setups or practices that I've thus far had people on the show. Can you just give a brief highlight, how many employees or however you choose to sort of discuss like size or capacity or, whatever about your firms or two businesses for that matter?
Yeah, for sure. So it's funny because when I coach the other lawyers, they're like, they're not employees, they're team members, and you grow with them and that kind of stuff. So I have that immediate reaction on there. So I have to also watch my language because I speak so quickly that when I say I have 9 team members, there you have 19 members. I was like, no, 9 team members. So we are a team of 9 individuals, and across the disciplines, one of the things that I'm really proud of is that each of the people that work as part of this umbrella they're knowledgeable, and we've trained them on both houses. So we've got things set up separately for all of the correct ethical reasons to have 2 different entities, but we cross-train and we really have people working for one firm, basically that company that they work with. And across the 9, we've got people that are in marketing. I have an executive assistant. I've got an advisor. I have an attorney that is becoming an advisor, or at least getting credentialed in that area, director of operations, and a couple of what I consider to be more of the client solution specialists, those people that just actually ship some of the things that need to get done in the plan. So I guess that would make us a little bit larger, but I had the benefit of having a fairly large law firm as we ramped up financial services. And right now, the 9 people that are kind of working together, and I'm one of them, but everybody that's working together can service the amount of people that we have and the rate of new clients that we're bringing on. But I would say that there was a period of time where legal that wasn't doing financial was much higher. And now it's basically everyone that comes in is just coming in for, I suppose, all of what we have to offer. They're buying everything on the plate, so to speak.
Right. Okay. Cool. Very, very good. Thank you. All right. Let's get into some of the general retirement planning questions now that you've come across in your time here. So what do you think is an area of retirement planning that many consumers overlook or don't give enough consideration to?
Yeah. Well, I have 2 different thoughts on that one. First, the one that is really about the financial component of it. I think most people tend to overlook shifting investment strategies across time horizons. So the way that I break that apart is that they've looked at one thing monolithically as a time horizon, reaching retirement, getting to that point in time where they could finally stop working. And they think that it is one decision to go into retirement. It's the next horizon. It's whatever that last 20 or 30 years is. And so they can just adopt a singular kind of investment strategy across that board. And I like to help them understand that there's actually multiple time horizons that you have to consider. There's the generation of money as soon as you stop getting it from your job. Then there's a sort of a midterm off of that. And there's something that's in the long term. And so that's one of the things I think that people tend to overlook, that it's not a monolithic decision about what you're doing with your investment strategy, as though you're just making one switch. On the non-financial side, I think the thing that people overlook the most is, what is their identity in retirement going to look like? They've spent so much time, 20 or 30 years, maybe even with the same company, establishing themselves in an identity around their work. And it's not just what it is that they did for their profession, but how that related to back at home. What they doing for the waking periods, and how do they bring that back? So when all of that goes away, people often overlook the need to invest in creating a new identity or creating a new purpose for what they're doing. And what I don't want to have happen is have their identity being the financial manager of their retirement as their new part-time job. It's a limiting path for it. And so if we can help them transform that so that they are getting that component of it, the financial component, in the rearview mirror so that they can now capitalize on the time that they have left, we believe that's really going to have people lead a much better retirement. And so that's really where we sit, is helping our clients lead great lives, because what we'll do is we'll take care of the thing that they're most worried about so they can be free to do the thing that they most care about.
Yeah, that's huge. The non-financial aspects of this are so important. And I and like this podcast are largely to blame because it's so focused on the financial and the numbers and the nerdy stuff. But the identity, the purpose, the fulfillment, the reason for getting up and having something to do every day, those are such hugely impactful and important things in retirement that I've appreciated more as I've been in the business, and I try to learn more about it to help people more about it. I'm not a therapist, nor do I pretend to be one, but I realize this is big stuff, and you have to have this addressed and planned for.
I would totally agree. I think there's a coaching element that is overlaid in my thinking around that, because all of the things that we help lawyers, let's say, do great practices for is leading a great life, and that's what they'll be defined by. And so it's going to be the same thing for people in retirement. The financial aspect of it is only one of maybe 8 areas that they ought to be paying attention to. They got to worry about their health, their contribution, their relationship with other people, their own continued development, maybe their spiritual, and what that will look like. So there's going to be this whole wheel of retirement life that they'll be evaluated on. And when they look backwards over that period, to be able to look at a balance sheet and say, wow, that's big, is only going to be a component of whether or not their entire retirement was successful. And so if we can serve a role, you and I as advisors, and us specifically with our company, in putting the financial element at its highest rating and in the rearview mirror, at least not something they are concerned about, then they can spend the time that they have focused on the other areas in that wheel of retirement life so that they can improve those. Because we've got one shot at this, right? And I don't want to be kind of overly, emotional about it or dramatic, but the thing that would help me, the thing that would hurt me the most in terms of my clients' lives is if they only managed it around the finances and said that was time that was wasted, that whatever we did, I could have done that better. So anything we can do to facilitate that view backwards and say, I took advantage of all of the opportunities that I had. I traveled, I had a great relationship with my kids and my grandkids, and I made new friends, and I improved myself, and I had these new hobbies. If you can look backwards upon that and be like, that was time that wasn't spent, that was the best years of my life, then that's what I think would help people really feel like retirement was worthwhile.
Yeah, agreed. And now, flip side of this question, what's an area or areas you think people often spend too much focus or attention on in planning for retirement?
How about the entire part of the financial that I handle for them? I think there's probably 2 areas, and that's 2. One is the straight line investment returns. I think people are focused myopically on the current set of what's going on, as though that's the only thing to be evaluating. They'll make decisions about retirement. They'll make decisions about their success in retirement, about whatever is going on in the moment. I just did a video for clients that responded to kind of this political uncertainty and said, look, if what you have is going to be driven by changes today and tomorrow, you don't have a plan. This is going to be much more difficult off of it. And so what we need to do is make sure that you understand that those types of things, the things that you can't control, really shouldn't be what's involved in your upfront. So I think that straight line kind of investment returns is one of them. And one of them that's really granular, I think people spend too much time on, is really looking at Social Security claiming strategies through a narrow lens without incorporating the rest of the planning around that. And so what they'll do is they'll be myopically focused on, well, if I claim it here and I live this long, then this is the total amount of money if I wait. And I said, yeah, all those numbers are known. The art isn't in that. And by the way, if you can tell me when you're going to die, I can get you the absolute most from the federal government. But the better focus is to look at in the totality of everything. And so, I think we're going to talk probably a little bit later, because you do so in the other shows, about what our distribution philosophy is and what we focus on. But one of the things that we will focus on is looking at the overall strength of their guaranteed income. In other words, how can we get them to the highest point of what they are going to be getting on a monthly basis for the rest of their lives? And if we can do that, then we can raise their level of certainty, we can raise their peace of mind. And so I want people that are thinking about Social Security to think about it in the more global context of everything that they're doing, not just in that trying to make a calculation, married, single, when, claim, what can I get? Because that's only a piece of the puzzle.
Right. Okay. Now, these questions kind of like jump without logical sort of transition because these were largely crowdsourced from folks I talked with. What types of questions would you want addressed by retirement planners? So if there's like a choppy flow to this, that explains it. Next question. So what are some major differences you see in doing retirement planning for single folks versus those in a couple?
Oh, I've got to reach back into my estate planning history and experience to kind of give you what I think is the thing that is most, different about them. It's been my experience that married couples, when one of the spouses gets sick, the other spouse will take on the largest part of caregiving for them. In other words, they're going to step in as the long-term care solution. There's almost no financial planning that needs to happen for that because they're going to break their back caring for their spouse. It's what they've done for 40 plus years. But when we deal with a single person, whether it's the surviving spouse out of a couple or just a single person, maybe they're divorced, there isn't the same path for having family start to care for them. Family has dispersed. Children don't live in the same town as their parents. We're not that kind of tribe any longer. And so when a single person is going to need long-term care, most of the time they're going to need outside help from that, whether it's just a home health care aid or it's assisted living facility. But the path for that is going to be paved with dollars instead of with humans helping along the way, their family members. So that's one of the things I really want to emphasize for our single clients as they come in, and also for married clients, mostly for the wives and sort of a straight couple. Because what will happen more often than not is that the husband will die first, and then you'll have been cared for if he's sick, and then the wife will be there for another 6 to 8 years, often because of the age differential when they got married and the longevity with the different life expectancy. And so I have to really plan more for what they are going to need for long-term care. And that's what I certainly would urge anybody that's listening is really think about that last remaining spouse or that single individual is often going to need to pay for their long-term care rather than have it be provided by a loving family. That's just becoming less and less the case.
That was interesting, and no one's raised that before. And I agree with what you're saying. Like, yeah, in a married couple, usually it's human capital that provides the support, facilitates the support. Once it's
almost
a single
at
person,
any expense, Andy. So you get the caregiver to almost compromise their own health in giving everything over. We often have to take some counseling steps, not in the traditional counseling, but just in our normal kind of the lower C part, dealing with married couples who might come in where they're already a caregiver for the sick spouse, and encourage them to invest in themselves, that they're going to be a better caregiver for their spouse if they don't spend everything that they have there. They'll be there for a longer period of time. They'll be there healthier. They'll probably honor what that spouse would have wanted for them. They're selfless and wanted to give everything to the sick spouse, and the sick spouse probably would have wanted to be selfless so that they have everything. Kind of have to remind them of that, because they will spend almost everything with health and their time and the what retirement looks like, that period, caring solely for all of those needs. And as you were going to, I think, conclude, is that when that spouse is alone or it's only a single person going through that, we're going to start writing checks to get the same thing done. Yeah,
that's interesting. Good insight with that. Next, do you think many, all people could or should do their own retirement planning? It's a bit of a loaded question for advisors, but I'm curious.
I was going to say, I'm going to be cutting against my own interest if I say anything other than, nobody should be doing their own planning. No, I don't think that that's fair or honest. There's really two categories of people that I think can do their own retirement planning. One of them is going to be those people with really high fixed guaranteed income in retirement. So what am I looking at? My parents, they're both school teachers. As much as they might have been my first clients, they didn't need our services because they're going to make about $140,000 a year for the rest of their lives. And then one of them died. I think it dropped to $100,000, and nothing of that was going to change. So when you have your needs cared for, while you could benefit from some form of planning to optimize what you have, the need isn't as great because your check just continues from there. And I think the other category is those people of higher net worth with a reasonable budget. So if I have somebody with $1 million looking for $100,000 a year, we're going to have real needs in their planning in order to be able to do anything that looks like being successful. But if I have somebody with $8 million who has got $100,000 in their retirement budget, look, they can make a lot of bad decisions and still be okay. It's unlikely that they need kind of the art of how to create income or make that distribution. So you will really, I think, in those two categories, have people that would be fine without one. Could they be better with them? Well, that's really where we spend the majority of our time with those individuals. I'm pretty honest with the people that come in with a large net worth and a small need. I said, you're going to be fine without me. You may not be the best that you can be. What are you concerned about? Is it a legacy? Are you at all interested in squeezing all the juice out of the lemon? Because if that's the case, we can help you do that. And that's really where I think where those clients will come in and work with us, is that even the people with a lot of money that are coming in and, probably not a strong need about how to manufacture that, what we can provide them, either offloading that work or really getting to a better optimal position is where our value is going to be for those kinds of folks.
Yeah. I met with someone very early on in my business, single guy, no kids, who was a government employee, retiring soon, between pension and Social Security, going to more than cover all of his needs. And he had like $2 million saved. And I basically ended the meeting by saying, if your biggest problem is having to pay tax on money you don't need, like that's a great position to be in. I can maybe help you optimize and squeak out a little more tax savings or whatever, but like you're going to be fine. And so ultimately, he's like, wow, I never had someone say that to me, that no, you don't need to hire me. And was eternally grateful. Now, he never hired me. Here we are 5 years later, but I feel good about what I said to him. I think it was an honest answer, and I think he felt great leaving the meeting. And yeah, maybe someone like that would hire you or me to try to squeak out that little extra bit of, whatever tax savings or what have you. But it's nice to be able to say that to people and sleep really well at night, being like, yeah, this person's fine. They'll be okay. Then just part ways at that,
And Eddie, this is a world of abundance. There are going to be plenty of people for us to help, probably more than we could ever help within our career. I don't care how large I scale, I'm not going to be able to help everyone who needs the help. So there are going to be the people that come across and be like, we're just not going to be a good fit, not in terms of personality, but just in the value that we're going to bring. I mean, it's not worth getting our tracksuit on for what you're looking for. Those people, I think, are in the minority because of the way that everything shifted. Once the sort of self-directed retirement funds got introduced and pensions kind of went away for everyone who was a government employee, then all of a sudden the entire industry, retirement planning, became relevant and important for other people to manage that down the road. And for the rare folks that are going to be like your prospective meeting that you had, and some of my parents, where it's like, look, you wake up the next month, there'll be another $10,000 there. It's going to be okay. Just don't blow it all. You probably will be fine, and those are going to be in the minority.
Yeah, definitely. All right. So now people who are looking for an advisor or planner, whatever name you choose to use, what questions should they ask? What things should they look for, et cetera, in that process? I liken this to a little bit of working in the medical field, which is that there are people that are generalists that are good for kind of base level questions, and their broad spectrum of knowledge and experience is probably good when the stakes aren't high. But when the stakes get higher, working with somebody who's a specialist in the area is probably your best bet. So if I had a heart condition, I'd like to talk to the general practitioner, but I'm going to go talk to a cardiologist, and I'm probably going to work with somebody that has a lot of people that look like me. And so in our world, that would get translated maybe between sort of net worth chunks, right? So we tend to work with people that are 7 figures and above, and that's rarely where our value comes in. But similarly, we'll go to look at people that are real folks that care more about others than they care about themselves, and want to work with an investor that's invested in them as they are in themselves. It's sort of a mix, like a match between those things. But the other component of it is that you never want to be too interesting of a case to the advisor that you're working with. So you almost want to fall into that category of boring because they've seen it before. They can help solve it. It needs to be something that, you aren't a particular challenge. And look, there are things on either end of the spectrum that aren't going to be appropriate for us. So we're not going to be great with people, a lot of international assets that have got all things that they've got sort of different country lines that they have to navigate. And by the same token, we're not going to be great with people that are looking to do education planning or handle sort of like doctors with debt forgiveness for their student loans.
there's not going to fit for us in either of those spectrums. But for the people that are looking to figure out how are they going to make it through to the end, what can they leave behind? How can they manage taxes? And I think you and I are similar in the same, we would work with similar kinds of people. Those are going to be really good fits because they're going to come to folks like us and they're going to say, hey, this is my problem. We're going to say, I've seen that before. I know how to help you get through that. You're kind of, more commonplace than you are unique in the way that you come in. Everybody feels like their issues are unique in that sense, and you want them to have the right treatment. But from the perspective of how challenging of a case is it, you don't want to be too challenging of a case for an advisor.
Yeah, great point. And I like that you and I and other folks like us do have that area of specialization and do intentionally will say, sorry, we're not the right fit if you're too complex, not complex enough, et cetera. Whereas a lot of the larger household name firms, if you can fog a mirror, you're an ideal client to them, right? And they'll get way ahead of their skis or over their skis, whatever that saying is, and really not be able to provide advice on the more in the weeds planning that they may need or the bespoke stuff, or give bad advice or whatever, just because they need to get new clients and just take anyone they can. So it's good to be able to be selective. Yeah,
their measure is completely different. When you're at the large wirehouses, or if they're there, their measure is really about client acquisition. And what they're trying to do is keep everything in house. And then of course they do have a battery of people that they can throw at stuff, so they can represent. At least they can handle, even if they're not really special in those areas. But I think that part of our obligation as fiduciaries is to look at a situation and be like, your best interests are not working with me. I'm going to do everything in your best interest, and that includes not taking this engagement. And I can think of things that are, within net worth, but just different kind of asset mix that it's not going to be great for me. We're not going to be a great person for has a lot of real estate holdings. I don't have a ton of experience in that area, and I'm not sure how to expertly manage them through retirement with that. So we're going to pass them off to somebody that's going to be better with that.
Same. I actually have a very similar scenario, client with too much real estate that I was comfortable for, and finally I was like, I'm not okay doing this. I'm not going to be able to give you the best advice about this, and was able to find someone for him that was a much better fit. So it all worked out well, thankfully.
Yep.
This next one's a little weird, but I think about it more than I should. Can the value provided by a planner actually be measured?
Oh, that's an interesting question. And I think maybe what is challenging about that is that we tend to think about measurement in an objective sense, like, 14 inches, or whatever it is that we'd be looking for. I'd probably say there's two different ways, or two different metrics of measurement that would be valuable, I think, for people that are working with an advisor, specifically, let's say in retirement. The first one is that they provide freedom for you to live a life where retirement planning isn't their new part-time job. I think I mentioned before that we don't want to replace the time that they were spending in their work now being the manager of their finances and somehow not freeing them up to go and lead that great life. So if the value is that they gave permission or space for you to go do whatever would be the definition of your great life, I think that can be measured, because if you spent the majority of your time somewhere else, we can't get that time back. I think the other measurement is that they lead you to a place that you couldn't have gotten there but for their help. So both of these, I think, are going to be measured in retrospect, in maybe over a period of decades rather than in a particular year or so. Maybe it's possible to do an accomplishment like that. But I think if you arrive at a destination that you can objectively say, hey, I wouldn't have gotten here if I didn't get an opportunity to work with Victor or whatever, then you probably have a measurement of value. And then the trick then becomes for you to feel like what you paid for that was a bargain. I have a lot of conversations with people initially when they come in, and I say, they'll charge about fees, and they'll have the discussion about how we're going to get paid and whatnot, and we'll tell them all the different ways that we get paid. But I'll let them know, you should think about this investment like you're getting one over on us. And if you feel like this is something that you're grudgingly coming to, this is not great in either direction. We don't ever want you kind of resenting our role in your life. You should feel that as an incredible discovery, something that happened that you didn't really thought was possible. And yet now that it's here, you wouldn't give it up. And so from that perspective, if the people, that advisor helps you arrive at a destination that you couldn't have gotten to but for their help, I think that's a measure of the value of them in your life.
Yeah, great way to look at it. Now, you're a well-educated, well-informed guy in this. You're a prolific content creator yourself, right? Formerly a radio show that turned into a podcast, and you got multiple books. But where do you go beyond your own stuff and my stuff, obviously, but where do you go when you're looking to learn or increase knowledge or what have you in terms of, content sources that you value?
It's funny. More recently, Andy, I've been spending time, I suppose, in the personal development space. For that, it's really in the education about how to create a great life. If the value proposition that we have for clients is that we help them lead great lives, and I don't know that I need a ton of additional education on the mechanics of retirement planning. I feel pretty comfortable when we do. Now it's a matter of keeping up with changes. Really, the area that I think that I need to spend the more amount of time is how do I help facilitate what a great life looks like for them. And I'll tell you, there are a number of different sources that come to mind for that, but I really try to get in front of as many thought leaders as possible. But I'm spending more time with the likes of people like Simon Sinek, I could get to meet him, but not personally, but finding education in those areas and then letting that translate to the kinds of conversations that I have with clients. And I wouldn't put it in the context of trying to shift them to a place that they don't want to go, but almost the facilitation of conversation that helps them discover where is it that they want to be. I think that journey of self-discovery where they said this would really be what would define a great life for me in retirement is value, sort of time well spent for what we want to create for them. Because if we're doing our bit and we've educated them well enough to know that, yeah, we can keep you abreast of what's going on with your finances, but we're not going to be doing a lot of different things every time that we meet, then what are we spending the time doing? And if the measure backwards is like, well, what did you do to lead a great life this last year? What can we be doing in project planning or tactical planning for the next year? And if that measure is that the wheel has increases in areas that are other than the finances, then that's going to be really valuable for them. So I'm trying to spend a lot more time getting better at that than I am in the nuts and bolts and mechanics of actual financial component of it.
Yeah, that's great. The technical aspects are basic table stakes, and you get to a level, like you said, where, okay, I got that. Granted, there'll be changes in tax legislation and whatever else, but like you got a solid handle on that. It's the other stuff, going back to like the non-financial things, the meaning, the purpose, the fulfillment, the et cetera. Yeah. That's something I know I need improvement in, and sounds like you're at that point as well. You got the technical stuff pretty well ironed out. Now it's like, let me really develop and improve on the other aspects of this. So,
yeah, absolutely true. And I think one of the things that I've been happy about over the last year and a half or so is really building out the team's knowledge to replace some of the technical things that I was the only person that could do from before. And so in the shift that happened, where now we've got all these people that are cross-trained, or that we've got now somebody who's very similar to me, having an attorney with an advisor, credentials, and kind of doing the planning component of it, the time invested to get them trained up is what has given me the permission and the freedom to go invest in these other areas and kind of think about how we can bring value to clients on those other areas and those other domains for what we're doing. And I think that if I didn't have a great team like that, and if I didn't have clients that were willing to work with the team as opposed to only working with me, then I probably wouldn't have the freedom to invest in that area. I might feel a little stuck.
Right. Great points. All right, this next block of questions is more practice-specific things.
Sure.
This first one you already sort of addressed, but how do you know if someone is a good fit for you as opposed to just you being a good fit for them? You already said you kind of rule out people with like the international complexity or too much real estate, et cetera, but how else do you decide if someone could be a proper fit for you and what you do at your firm?
It's funny because in the whole client journey, when they come meet us, when they first meet us to when they eventually become a client, we're asking for what look like financial statements and their bona fides off of that probably late in that process, because my focus in the beginning with the idea that this is a lifetime relationship for both of us is really trying to figure out, are they real people with a student's mindset? Do they value education and empathy as much as I value that? I mean, we're working with people that invest as much in other people and things as they do in themselves, like more in that area. And they probably want to work with somebody that has that same mindset. So I'm trying to figure out, where do they land on that spectrum? Because I want people that are going to value the focus of what I do, because we don't provide our services with, let's say, with a clap on the back and trust us, and we've been through this before. We invest a lot in education. Our client education events are really well attended, and the things that I take a lot of, I don't want to say the words pride in, but I invest a lot in making sure that they're super valuable, and we're spending a lot of time in that technical area of really trying to teach them what it is that we're doing so they feel super comfortable, and I love the teacher's role. So I want clients that want to be in the student's role, at least with respect to this relationship. And I think the other element of it is that they want to make sure that they are caring about a great life. There are people that come in that just want the service, and it becomes very transactional, not very relational, and they don't really care about leading a great life. They just want to look at investment returns and what can you do for them, and they feel like they're kind of purchasing a ham sandwich. I'm like, I'm not really a ham sandwich provider. I'm more of a dietitian, and I want a long relationship, and I want to do all these things. We're going to talk about your like going to the gym and whatnot. And if that's not your gig, and if you don't want that relationship with us, then you're probably a bad fit. I'm fond of saying that we probably want to hug you a lot more than you thought you would want to be hugged by a financial firm, both literally and figuratively. And so those people that are going to be resistant to that type of relationship aren't going to be a great fit for, first of all, not only our team working with them, but they won't be a fit for our client community. They'll be on the outside of that, whereas our client community has a lot of, it's not just because they've referred other people, but there's a lot of commonalities that are in there. People have developed friendships from being part of our client family, and those friendships go out in the world outside of our events. So we want people that are similarly positioned, situated kind of thought process. And those are going to be the areas, Andy, that I'm going to spend a lot more time in finding a right fit, and less so much so in terms of the asset composition or how much do they have or those types of things. That stuff typically works itself out ahead of time. And we're looking to kind of deal with real people that we like. And we're lucky enough that that's the majority of our client base.
Yeah,
now,
like
the fact that I said majority might have people that are listening that are my clients trying to figure out, am I in the minority and which one did I miss off of it? But really, it's almost exclusively those kinds of people.
Yeah, I like that. I haven't been to your office space. Like I said, I went to one of your workshops. It was at an independent location, but I know you do have proper educational space, and you do routinely do client education. They're not sales events. It's like for people who are already clients, you do these formal events, right? And now I'm just curious, are there, for folks who might be virtual clients of yours or want to be virtual clients, do you have some sort of replay of that, or is it only the in-person things that you do?
In the beginning, I think we were too dumb to realize that we probably should have recorded it. I think it's like Gary Vee's approach, like just record everything, just document everything, and you'll have it later. We got a little bit smarter, and so all of our events are now simultaneously recorded and then replay, if available. Replay sometimes it's for the people that were in the room, because I am famous for talking too quickly, and so people come back, they're like, I got 30%. And I'll just hit play again and get the next 10% from there. But we do have that available for other people, and it's now become a little bit more of a library that we have available for folks. One of the interesting initiatives that we've launched out now is creating almost a client platform or a membership platform for our clients, sort of like one of these Teachable or Kajabi or Mighty Networks. And what we're doing with that is actually making it almost exclusively for clients and almost exclusively about the content that we're providing. I found, and I don't know how you feel in these days, but I found it a lot more challenging to communicate with clients, let's say over email, or we expect them to go to a YouTube and kind of watch something that's in there or subscribe. I kind of want to go where they are, and I want to give them a different portal to do that. So all of our events are populated there. The entire repository of our library is there, and it does become an additional sort of value for clients. I don't really say that's what you're buying, but I know that it's not available to the general public, and so those types of things now become a library for them to go through and then have access with each other. And whether we're sharing things like where to audit their next college course for free, and if they want to learn this, that, or the other thing, or it's actually our own content, we want to give them that conduit between sort of who they are and how they identify and being able to get connected to the things that they care about.
That's cool. I didn't know that. I don't know you have like this online repository or almost community of client resources and stuff. That's really cool.
Yeah, and it's almost closed. It's only for people that are inside clients or they've just recently come on. And we might give some of that stuff available for prospective clients, but we really wanted to be a value for people that have agreed to work with us and doing the thing that you talked about, which is capturing all of those education. Even if I had it there, or even if I give an email with a replay, people, I don't know exactly the time and place in which they want to revisit that. So we want to give them a place to go for everything that we have.
Yeah, that's slick. So we may have sort of segued into this a bit, but have you ever had to part ways? I'll say fire a client. I know it's not the best word, but and if so, are you willing and able to share circumstances around why?
Yeah, it happens very infrequently. I'm lucky, blessed, fall into it dumbass backwards, I suppose, to having clients that we like almost exclusively. It's very rare that someone will get through becoming a client without having self-identified whether or not become a problem. And there was really two circumstances in which we had to let a client go, sort of fire them, or I think the nice way of saying this is we transitioned them away. We find another advisor. One of them was just plain rude to our team. Delightful to me. Just absolutely the nicest person around me, and then treated our team as though that they were somehow, servants or beholden to them, and was just kind of rude to them. And that doesn't work. My team is the reason why we get anywhere. And by the way, as a client, you don't get the results that you're after without them. And then the other one, we just kind of breached that level of integrity where we were dealing with a situation. It was sort of an elder law scenario where we had shifted assets inside of an irrevocable trust. It was kind of a technical thing that we were doing, and the kids were there involved, really supposing to have to manage that money for mom and not for themselves. And we started to see a lot more requests where they were trying to deplete off of that. And look, they had the authority to do that, and we had to let mom know what was going on. Then mom lost capacity, and they kept doing it. I was like, I want no part of this any further. It just didn't strike us as being the right thing to do. And so just getting rid of somebody that wasn't doing what we thought was right by our client, right by the circumstances, it was an opportunity to say, we're not going to be the good advisor for you, and we're certainly not going to stand by and watch this happen. So we had to let them go as well.
Okay. Yeah, makes sense. Next, we could probably spend a whole episode on this, but maybe try to keep it as concise as possible. Your view and your firm's approach to investment management, now whether it's active versus passive, or how you actually implement, or what have you. I mean, how does your firm go about investment management?
To avoid boring everyone, right? Because I think we could go into all kinds of, specific on the theory. My approach or view to, let's say, the Wall Street side of investment management is that I tend to believe that all the information's out there and there really are no secrets. I think anybody that's promising otherwise is simply guessing and hoping to be right, but we don't take the approach that we somehow have an in and higher available knowledge. And in fact, I almost cut off a whole area of working with clients that are pre-retirement because I'll say, accumulation strategies, they're pretty well set. I don't think you need me to give you that, probably just maybe as a speed bump between you doing something dumb versus doing the thing that was already known. So I think from that perspective, that everything is known. But by the same token, when we think about investment allocation, what kinds of investments to own. So we start to go beyond the Wall Street world to say, well, what are the tool set that you should be looking at for you to be able to create this kind of confidence or success in retirement? Everything's on the table. We're sort of agnostic about what that is. We don't have a particular belief that these things are bad and those things are good or whatnot. I think everything has got a place. It really is whether it's appropriate for a client. And so from the perspective of people that are saying that one thing is wrong or there's a whole swath of things off the table, I'm fond of saying you got to figure out how they're getting paid, because typically when something's not available is because they don't get paid that way. But other than that, as long as we can help somebody and it gets to where they want, now we take a look at all of the tools and say, okay, great. Now what is appropriate for you based on what these tools do? And from that perspective, I'm not married to one thing over another. I'm just married to the thing that works.
Right. Which, as it should be with anyone, right? It sounds so logical when you say it out loud. So
it's too easy if we just say it out loud that way.
It really is. Now, with regard to investment management, this specifically was a crowdsourced question. Do you do any sort of benchmarking? So the portfolio you put together for someone produced X percent. Do you compare that versus whatever else? Yes or no? Why or why not?
Yeah, there's two levels of benchmarking that I think are relevant, and one of them is directly kind of relevant to the sort of the technical nature where the question came from, which is we absolutely show how our investment strategy and the places that we're at is performing relative to benchmarks. At minimum, we want to keep pace with them, maybe do a hair better with some of the investment strategies that we have, because maybe they're lower cost, maybe they're more efficient, maybe they put their thumb on the scale in areas that we think tend to outperform even what the benchmarks are tracking, let's say. And the other area of that for us in terms of just our overall returns is really a comparison along the guardrails that we have created for them within retirement. And so the benchmarks are, have we remained within the things that we said was important to remain? And so are we on the trajectory that we had plotted, or have we fallen off in some fashion? And that tends to be similar in a benchmark that you're kind of comparing where you expected to be to where you currently are. And for our perspective, it's an opportunity to have information that we can then decide, is there behavior or an action that we need to take? So do we do anything with this, or do we just mark it for what it is? Often with the investment returns, we're simply just marking what it is. I don't think that anything's going to change too much, but we want to be able to represent that our strategy is well thought out, evidence-based, and here's what we expected, and here's what happened. On the actual practical performance side, there's a lot of what we're doing, especially in the early years of retirement, that says where we are on the launch of this has got a lot of variability. And the changes here have a magnitude of where you can end up as you continue on that trajectory. So it tends to be much more important in the early years that we remain on trajectory, and probably less important in the later years, where maybe even the shift of the goal of our planning has changed, where the benchmarks that we're matching to has been, well, the confidence or where we were in retirement success has been met, let's say in that 10, 12 years or so. Now, what are we doing on the benchmarking for what we're going to be leaving behind, or changing our strategy, or something along those lines? But I would look at both of those as being sort of official benchmarks that we're tracking. They are things that we are reviewing with clients on a regular basis. And while one is historically and kind of commonly known as being, well, how do you compare against the Russell or the S&P or, Bloomberg's or whatever else, the other area is probably much more specific to our planning, retirement planning in general, but specifically to the plan that we created for that client, and not historically what's available kind of in the entire market. There's not an entire market of retirement plans saying, well, you compare it like this against those people.
And that makes a lot more sense because it's more applicable to them and their scenarios and circumstances, right? To benchmark that way.
And so much of it is a variation, or it requires variation based on their circumstances, right? We have totally different Social Security awards that are coming in, different fixed income, different starting bases, different ages, different budgets, different needs, different time circumstances. Did they sell a house? Did they move the house? Were they expecting to? What did they get for the house? Because there are all of these little fractals in which you can end up in different places, each one of them is going to be very specific to the client. And that's really, I think, where having somebody that looks at and has experience with all of those, advisors that focus on retirement planning, can help guide, because none of those questions are going to overcome or somehow stump what the planning needs to happen. Is just taking the information in and being able to give good guidance about where to go next.
Yeah, definitely. You clearly have a very thought out process. I mean, that was a exceptionally thorough analysis of the idea of benchmarking and how you use it and apply it. So thank you for sharing that.
Yeah.
All right. Annuities. Now, I know I believe you lean as a firm more towards like the safety first approach as opposed to the total return approach, with the other sort of end of the spectrum. What's your firm's view and usage and application of annuities?
We use them routinely and regularly. I do break them out into three different categories, though. One of the categories for us is using annuities to create guaranteed income. And that's often not within immediate annuity, because my biggest concern off of that is that if somebody happens to die, I've enriched the insurance company and not my client. So we tend to trade having a slightly lower payout for making sure that the value is always there with either a death benefit. In some fashion, they won't be harmed by using it, but we're trying to stabilize income for the long haul. And that's typically with people, I wouldn't call them lower net worth, because we'll use them with people that have $1 million or something like that, but they tend to be on the lower end of the net worth. The middle category, maybe towards the higher end of net worth, is really kind of asset stabilization. We want to create stable investment accounts from which to withdraw for a period of time, so that we don't have the variability that would otherwise be introduced. And I think the third category for us would be special purpose. So we'll create irrevocable trust to help safeguard assets from nursing home expenses. And those are often best paired with a form of an annuity because of the tax deferral, the easier administration for the kids, things like that. Or I might use an annuity with a long-term care rider for somebody that couldn't pass underwriting on some form of another policy. So there's kind of in that category of special educational purpose off of that. But we're really upfront with clients. I think any time that you introduce an investment like an annuity, or you put that into the plan of what you're doing, you're going to trade a potential higher outcome. In other words, if I follow the trajectory of just keeping them without the annuity, there is a whole potential outcome that's going to be higher than where you're going to be. But most of our clients are comfortable leaving slightly less or some amount less to their kids for having what I would represent as being a higher confidence that they'll be okay, and they're willing to trade that off. And so as long as our clients agree with that, then that's usually where we'll start to incorporate that. And then, you know, on a real practical sense, I almost never will have an annuity in place past the first decade, maybe 15 years of somebody's retirement. Once I've gotten past the riskier part and I've watched the portfolio do what it needs to do, it's very unusual that we'll use anything in annuity. Maybe a multi-year guarantee annuity if the rates are, you know, more better than, let's say, CDs, and I don't need liquidity around that area. Maybe we'll go and capture it that way, but it's much more of a you know, circumstance of somebody continuing tax deferral, let's say, and I've exchanged it or something along those lines. But for the most part, it's really in that initial stages where I'm trying to control for things that I can't otherwise control for, which is what that first decade is going to look like.
And that's important framing around annuities. A lot of people have, in my opinion, ill-informed biases against them, that either they're expensive or the returns are too low or what have you. And like you said, you're giving up the potential for higher outcomes by traditionally investing in stocks, bonds, mutual funds, whatever. But there's a lot of guarantees, less uncertainty, more known about the outcome of annuities, and there's value in that. And it should, in a sense, cost something. So yeah, you have to go eyes wide open. There is a trade-off in it. It's not like you're just giving money away. You're getting some guarantee, or you're getting a certain amount of income every year, or you're getting whatever, you know, guaranteed death benefit. There's value in that. People need to keep that in mind, right? Which is important to know.
I absolutely agree with exactly what you said, which is that everything comes at a compromise. As long as the trade-off is something that is acceptable to you and probably best for you, then it's an okay thing to do. Because look, I like to say the insurance companies that we're working with, they're not a charitable organization. They're there to make some money. But I'm okay with what they're making, and you should be okay with what they're making, because here's what we're getting in return. And we prefer the thing that we're getting in return to the thing that we might possibly get by not doing it. As long as that's all laid out, then of course all of these things become a good trade. By the way, we could exactly do the same thing in investing money in the market, right? We could say, look, here's the trade-off off of this. This is what they're going to be getting, and you want that instead of the other thing that you could get. Like, yes, you won't have security over that money. The thing that you had everything in your CDs and your savings account, you're going to lose some of that. But we actually want what that has for what we're trading off. And so you can kind of go and pull at this as all of the different composition of what would go into this kind of a plan. And we just need to be comfortable with each of the trade-offs. It's kind of what I said earlier, which is everything has a place on the table. And we just want to make sure that we're serving the right amount on the plate for what we need, for what that specific client needs.
Yeah, every product, every strategy, it has its pros and cons. Maybe it makes sense, maybe it doesn't, either by itself or as part of a bigger plan, bigger picture. Annuities are no different. They're simply a product, they're a tool. They shouldn't be forced upon everyone. They shouldn't be just blindly said no to by everyone, right? Like, if they fit for you, if they're the best solution, great, go for it. If not, so be it. Then don't use it, you know?
Sure.
All right, trusts. Now, I learned a lot from you about trust from one of your books. I think it was called Ducks in a Row, Getting Your Ducks in a Row.
Okay.
From your podcast. And I love this question because I get different views, including from some folks who are estate planning attorneys and create trusts for a living.
Yeah.
What's your view and your firm's view and usage around trust? Now, I'm talking about the regular plain vanilla living revocable trust, not special needs, not, asset sheltering trust, just like straight up living revocable trust. What's your view on those?
Well, I fell in love with them. I want to marry them. They're nearly 100% of the time, recommended nearly 100% of the time. When I've experienced people coming in with preconceived notions about trust, they usually fall into one of two categories. Either they think it's a cost differential. So they say, well, listen, I want a will instead of a trust because a trust is more expensive. That's the first category. The second category, it comes I think kind of related to that, which is on the execution, the implementation side, which is that they're complicated. And so what I've done is sort of shift around those ideas. Within our law firm, we've never charged differently for a will or a trust-based plan. It's the same flat fee. You're accomplishing the same thing, getting your ducks in a row. So now that we have gotten cost off the table, can I explain to you the way these two things work? And you can decide which one you would prefer. And almost universally, people will pick the trust because of the way that it helps them down the road. The second component, which I think has to do with the lawyers that have a hard time recommending them, let's say that they're not in favor of them, those fall into two different camps. One of them for me is people that are having difficult times talking about pricing, having a hard time having difficult conversations with their clients, because they'd rather have an easier conversation that gets them to set up a plan than the more difficult conversation that says, you need this, that you get benefited by this, and I'm going to invest the time ahead of time for you to really understand that, because I think that you're going to be better in the end. The other component of the people are those people that are layering their practice with little lotto tickets, because the expense of administering something later, you either deal with complexity up front or complexity later. It's the same thing. It's just going to be a matter of how many cats do you have to herd and who's in charge of those cats later. You know all your cats. Would you like to take care of this when you know everything that's in there, or you want your kids to take care of it somewhere afterwards? And often the estate planning attorneys are looking at estate administration as a profit center where they run hourly, and it's what they call other people's money. And so the kids are writing checks, not really understanding that they could have seen something better if they had just done some planning up front. So I'm really dogged about the use of trusts. I believe that they are universally easier to administer. They have specific benefits in places that are not necessarily just difficult with probate, but even difficult, like here in New Jersey, we have an estate tax lien or inheritance tax lien, and those will freeze assets, and then the assets in the trust avoid them. So we really think about them from the perspective of using these documents somewhere down the road. And we have the benefit, especially now that the firms have become kind of just one umbrella, that we're doing everything for clients, to be able to handle what I think is probably the most difficult part of creating trust, which is to fund them. I mean, they're not magic books. You create a bucket, you got to put the stuff in the bucket. Well, we can handle making sure that everything's coordinated in-house, and so clients can have a higher compliance rate with making sure that they work the way that they're supposed to than when they have to deal with somebody else. And sometimes the advisors are not interested in doing the work to retitle accounts or getting them funded. So I encounter all kinds of resistance in this area, but what we can't get challenged is that the clients themselves are materially better for having them in place. And so when that becomes the thrust of how you do your planning or why you're making your recommendations, you almost accept all of the other struggles that brings, whether it's more investment to getting them comfortable of it or doing the back end work to make sure that that gets done. All of that stuff now becomes secondary and necessary, acceptable once you're doing the right thing for the client. And I believe that it is that nearly universally having people have trust. The only things that we start to see that are outside of that are going to be in really specific situations, like people with asset protection needs because of long-term care, where I don't want commingled assets. I want them separate, and I want them to go according to will. And that's a whole other technical area. But if we're just talking about what you said, which is plain vanilla kind of doing your estate planning, your something to get your ducks in a row, we tend to believe that universally people should have trusts.
Yeah. Now, you're licensed to practice in New Jersey and Pennsylvania, correct? Now, this isn't legal advice.
And New York.
Legal advice.
I'm a triple threat in New York, New Jersey, Pennsylvania.
Now, from what you just laid out, it sounds like you believe they are universally, generally better for folks. Now, I'm just curious, to your knowledge, is there any state-specific reasons? Like, I know some states, there's a much clearer case to have a trust because probate's more expensive or more onerous to administer. How much state consideration comes into play, or do you still truly feel that for everyone, they're generally better than not?
I've had enough experience over 20 years to be comfortable with almost every state. I probably have had a client that has needed work in some fashion in any state. The first thing that comes into that layer is, let's say, for example, I have a client that is here where I am and with real property somewhere else. Well, then the trust, no matter what the rules are over there, becomes the recommended platform for them because they'll avoid dual probate because it's real property. Then if we were going to deal with somebody that solely lives in that area, if it's not a place that I already have experience with, then we're certainly going to go do that background research. But I can tell you, for example, we know that, California, they have places in strip malls selling revocable living trusts for $250. because the probate system is so bad there that people are just everyone knows to have one. So from that perspective, you kind of are aware where the things end up being more difficult and where it's there. But I would say that if anybody came in where we were uncomfortable about that recommendation because we didn't already have experience, we certainly would want to make sure that that's not going to hurt them at all, and that it's not a wrong decision for what we need to be doing, and make sure that that is nailed down. But I've yet to encounter it in 20 years. But there probably still some states that I don't have a Hawaii client. I can't tell you what happens in Hawaii. I want a Hawaii client. There should be a Hawaii. If you're a Hawaiian prospect and you want to talk to me because of this podcast, please give me an excuse to go to Hawaii and visit you, and then we'll figure out your estate plan.
You heard it here first, everyone. All right. Long-term care insurance. What's your approach towards long-term care insurance? Now, curious, do you sell it? Do you not? Or, when you do feel it's of benefit, do you have somebody you work with to get involved in that case? Yeah.
So we definitely provide it, sell it. We offer it here in-house. We have the benefit with the legal and the financial to look at long-term planning from two different avenues. You can solve it with legal planning, you can solve it with financial instruments, and both of those are on the table when we discuss clients. And so I think that long-term care should be addressed. Now, how it gets addressed and where is it in the order tends to be a little bit later. And by later, I mean, I need to make sure, it's kind of like put the oxygen mask on yourself first. I need to make sure that we've got confidence around the income and investments, because I know there'll be a point in time in which you'll stop working. And I know that you're going to need money for the rest of your life. I don't know that you're going to get sick, right? So in terms of the hierarchy of things that are going to happen, I need to plan about the thing that I know is going to happen. And then I can look at this thing that might happen and control for it. So typically, if we're going to look at financial products to solve long-term care issues, the first category for me is I like things that are fully paid up where my costs are controlled. I don't like the kinds of policies in which they can start to raise premiums by class, all of my women over age 80, where I'm now introducing pressure on their cash flow at a time in which they most need that coverage as they get older. So I want something that tends to be fully paid up, often things that have some form of return of premium if I don't use that money, or a life insurance element to it that can pay out a death benefit. And then when I look at the composition, it's very difficult for me to justify allocating anywhere more than about 8 to 10% of the portfolio to something like that. In other words, the math just doesn't work out if I carve out something more. And the way that I explain it to clients, Andy, is that I say this is a time shifting. So what we're going to do is we're going to take some money that we have right now to be able to control for this thing, that if it happens, it'll help us control that. But what we're going to do is we're going to lose all the growth on that money. So we're not going to make anything on it. The best case scenario is you're going to get it back for exactly what it was over 20 years, and it didn't grow a dime. And maybe if you don't use it to take it back, a little bit more will be left to your kids. But we can show how not having that available for you to spend doesn't impact whether or not you'll be okay. We actually have that as a buffer. We can use that and give it a different job, and that job helps you, doesn't hurt you on the other thing that we care about. And as long as you meet kind of the underwriting for that and you're healthy enough to get it now, then it's something that we can put in place. So that's sort of the way that I piece through that. And for me, it comes a little bit later once we've secured the most crucial things, and then always something to be examined, because it's one of these things that the costs are just, they're rising out of control, way above inflation, 11, 12% a year over year. And I think with no end in sight, we're getting really good at keeping people alive for a long period of time, no matter the state that they're in. And so I don't think anybody's coming up and saying, well, actually, I will just die. You actually probably won't have any choice on that. If you need a long-term care, like assisted living, if you've got Alzheimer's, they're not going to take you out back and shoot you. So now we're going to have to figure out how to pay for your care in some fashion. And often when it's a single person where there's no other family to care for them.
Yeah. And I'm not saying this is a scare tactic against long-term care, but to your point about rising costs, I work with someone who has a traditional long-term care policy. He's had it for a while. It's quite generous in terms of its, the total benefit and inflation and what have you. He got a notice the other day, on top of there having already been a few increases over the last few years. He got a notice a few months ago saying your premiums will be going up 200%. Yeah. Not doubling, like going up 200%, so tripling. And he was already told ahead of time. Now, he lives in a state where the state limits it to no more than 15% increase per year. So the writing's on the wall. His premium is going up 15% per year for multiple years, and that's a tough pill to swallow. Now, he was given the choices of like 6 or 7 options of reducing coverage, getting some really, really small, fully paid up policy, et cetera. But anyway, it's hard to stomach that later in life when you most likely to need it, and cash flow ding could be really heavy, and it's a tough one to plan for. So,
and you introduce at that time, Andy, like this whole the people you have to now start to consider like the difference between being okay and still having money to spend and controlling for this other thing. And they're like, well, which of these Sophie's choice do I make? And they're forced to do one of them. It's like, hey, if we could do anything to kind of put that issue to rest, we're probably going to be in a better position than if we didn't.
Yeah. Yep. I agreed. All right, distribution planning. You sort of touched on this with usage of annuities where, appropriate for folks. What's your approach to putting in place a distribution plan for folks?
One of the most important things that we do is help create the highest level of guaranteed income as possible for them. I'm trying to get them to the point where their safety, their livelihood, how well they're going to feel, how confident is an issue in the rearview mirror. And so what we'll first try to do is create that level, and not at the exclusion of other things, but we say, listen, if this is what your budget looks like, can we do that in a way in which you never have to worry about that again? And it may take some time before we get there. Maybe something that isn't fully in place until you claim Social Security, maybe somewhere down the road. So maybe we'll have 6 years of times where we're really not sure what's going on. But at this point in time, once all of the spigots have turned fully on, now we can stop worrying about what's going in there. We've established it. And so I'll use all of the available tools for there. It's Social Security claiming strategies. It's, annuities that have maybe stable accounts with full 10% premiums distributions, not just account value, but original premium, or it could be an income rider or something along those lines. But I need to have them plan to live longer than expected, sometimes longer than desired, longer than expected, and for it to be more expensive than expected. And so when we look to set the variables off of that to plan around, I'm usually bringing out longevity to at least 100 these days, and certainly putting inflation maybe 3.5%. And if I can get there with a degree of confidence and plan around that, it's a place that my clients are comfortable living, and it's a place that I'm comfortable standing behind something that might be 20 or 30 years down the road. I have promised my wife that none of our clients are going to come and live with us because they run out of money. So I have to keep that promise and make sure that I've planned for all the time that they're going to need.
That's an important overarching goal of your business, I think.
Absolutely. So, yeah. Stay married, keep my wife happy, and don't give up my spare bedroom to one or more rotating clients that run out of money.
That's it, yeah. Now, this was a specific question that came from a few people around distribution planning, like, consumers. Do I get some reports? So I had the question, like, I want to see something on paper that shows for the next 10 years, here's exactly where my money's coming from. Less so from the annuity angle, but like taking out of different accounts, and here's why. Yeah. So do you have a deliverable in that sense to people about their multi-year distribution plan?
We do. We begin our planning, Andy, by using a document we call a transformation. It's a big proprietary for us, where we look at income, investments, taxes, and estate planning, and we really work through 3 different phases. We call them realization, orientation, and implementation. So the first step is to take stock of what we have. The second step is to then figure out what we need to go and do, kind of agree about that. And the third step is actually to ship it. So that's those okay. 3 phases off of it. Now, I take a little bit of a counter approach to the question, which is, I don't think there's a lot of value in a deliverable that's given on day one about distributions, because if it requires assumptions about what's going to be going on,
right,
then the real value is in the course corrections that need to happen. So it's really more of an ongoing thing. And so we do use a piece of software that I really like that not only gives us where we're going to be drawing from and the sources, but shows the sources change over time, the taxability of it, where it's going out to, so how much is being lost to taxes, spent on taxes, and how much is going out to other sources to available for spending, and then watch that happen over each of the next 30 years of the plan. But that gets updated for real time every time we're making decisions. And so when we look at whether it's as straightforward as where do we take an RMD for this year, or if it's as crucial to the planning as where am I getting income at age 62 for the next 8 years or so, we really want to make sure that we're actually making on the ground decisions with relevant information. And so the deliverable, the planning tool that's in there, while it is available, it's certainly not something that you can then take like stereo instructions and go implement on your own, because so much is going to be dependent about what information do you have the next time you have to make a decision.
Yeah, that's my view as well. Not that I'm trying to be lazy or like hide info from people, but the plan itself, especially something like a multi-year distribution plan, it's outdated and wrong basically as soon as you print it off and give it to them. It's really the course correction, the keeping it a living thing along the way and making changes as necessary as a value. So, some people want the deliverable, and I try to say, like, I'm not being lazy. It's just, it's really of no value or minimal value, right? But
yeah, it's to give you the justification for the decision today, and the next time we do it, we're going to have to give you the justification for the decision tomorrow or next year. And that's really where I think where the value comes in. The plan in and of itself is not where the value is. The value is in how do you interpret new information, and do you have confidence in the advice being given to you about what to do with that information. So that's almost the reason why we will create a plan, at least our process, is that we will create that plan without any charge in the beginning, because I don't put a lot of stock in that plan itself. What we really want is the relationship, and we want people to see a little bit of the way that we think. They want an understanding about what our approach is, because they're going to need to get comfortable with us giving that advice on a regular basis. And so if they look at it as just a set of a recipe on how to cook a cake afterwards, and they're going to go do it on their own, what's going to happen when I'm swapping out eggs for something else, and then all of a sudden I got to change what I'm doing.
Yeah, exactly. Or trying to make it like keto friendly cake. It's just not going to end well.
Every time they tell me they used applesauce instead of something else, it's like applesauce. Sorry.
Yeah, it's all right, but it's not the same. All right, tax planning. What are some common opportunities you come across? I mean, I guess the low-hanging fruit obviously is like Roth conversions are all the rage now, rightfully so. But above and beyond that, anything in particular?
They definitely are in there. I would put one category in there that you and I are both aware of, but maybe consumers are not hearing as much. I think one of the biggest tax planning opportunities for married couples is when they still like each other and they're both alive, but they remain married. So planning around the married filing jointly schedule versus the single. And that can be dovetailed with Roth conversion. Certainly you can have that conversation about what you will do with that, but understanding what the impact of changing a filing status is going to be down the road when you still have all of the balance going into the surviving spouse's name and you're now filing single in a different schedule. That for me is a tremendous planning opportunity. We really try to take advantage of the fact that we have these years of good health, and it's almost morbid to think about it this way, but I have a client that I'm working with now, and once we've got past the grief stage of her losing her husband, I said, one of the things we have to take care of is your last year filing jointly. This is the biggest size bucket that you will see for the last time. Let's really pay attention to this, because we don't get to go backwards and make any difference. The other tax planning opportunity that I love to share with especially grandparents who've got a little free cash is dealing with their grandchildren who are employed by making the Roth contributions for them in that year. That we understand the gifting, but I think often people don't layer it with the tax planning. And, you can divide it up. You can kind of give $7,000 if you want over here, and then, give another $10,000 there if you want. That's fine. But really what we're thinking about is there any way to kind of patent or really kind of amplify the taxes, tax planning element of it. So I love being able to gift with tax planning in mind, and I love those opportunities as well.
That's a good one. Gift, as a grandparent, gift money to the grandkids' Roth IRA, assuming they have earned income from a job, right? That's
exactly right.
Major black and white, yeah.
Because typically, Andy, right, the grandkids are not in a position to have excess cash to save. They're probably just scraping by. They're not sitting on $7,000. They certainly couldn't, kind of carve it out. But if the grandparents are sitting on that amount and they can make that contribution in for them and just write the check right in there, the federal government doesn't care where the money comes from in that sense. It doesn't have to come from payroll deductions. And so if you can make that gift and they can watch that balance grow, and we can kind of get the kids on the path of zero taxes and really loving that account, it's a great way to marry something that is a gift with also the something planning. They can share values as well as sharing cash. And then both of those kind of come together.
Yeah, definitely. Now, we talk about a lot of nerdy, technical, really meaty stuff, and there is a lot of in-the-depth stuff that needs to happen here. But a lot of clients just want to know, am I going to be okay? Or, what have you. So how do you balance getting necessarily in the weeds to the level it has to be done to do good planning to really synthesizing it and making it like a coherent summary or plan for a client who just wants to know, am I going to be okay type thing?
This presumes that I'm good at doing that and actually have a response. I think probably one of my faults is I probably spend too much time in the weeds, and it's often highlighted to me when people are like, you talked way past what they needed. And I was like, yeah, but I had all this other information. You don't understand. It's the law degree. It's the lawyer coming in with it. I think the best thing that we can do is that in the deliverable of what we do, so probably two strategies. The first one is we look at things in time horizons. So we're not trying to make all of the decisions at once. So if we look at a short period, maybe 1 to 2 years, and then maybe years 3 to 7, and then years maybe 7 past or 10 past. Digesting it into those chunks really helps the client understand and marry some of the complexity that we may be putting in place today and why it's needed with enough information, but not kind of losing the forest for the trees, so to speak, trees for the forest. Like you, I don't know which order it goes in. Mm-hmm. The other component of it is to really have that spots check on where they are as they're projected. So we talked a little bit about the trajectory. And so I'm fond of using graphics to help people understand things that are in numbers. Numbers suck. Looking at numbers and cash flow distributions, having a whole table, it's not anything anyone really wants to see. But if I can show a trajectory path, and if I can show guardrails, and if I can show where they are and where they need to be and kind of show that over history, it helps people understand where they are. It includes the complexity without getting lost in it. And I think part of our obligation as advisors is to simplify the complex, or to bring order out of a lot of chaos. You're not going to get rid of the chaos, but if you can sift it in a way that becomes digestible for someone, then all of a sudden they feel really empowered to make decisions and feel like they're on the right path.
Yeah. Definitely. Now, you sort of touched on this in a couple different pieces and parts already, but how do you help determine if someone has quote unquote enough for retirement? One of the most common questions is, do I have enough, or am I going to be okay type thing? And how do you present that or get comfortable behind that?
It's interesting because I almost reject the question about what enough looks like. I mean, I know people are driving that by a budget that they have. I'm more comfortable saying, this is a place of no judgment. What you have is what you have. What it can do, I can do as much magic, but it's going to be what it can do. If you want something different, then you're going to have to change the variables that you're giving me, right? So either delay what your retirement looks like, save more, kill off a parent, something. You got to do something to change the beginning variables. But I really take the perspective that my job is not to answer the question, do they have enough, but to show them what's possible from what they have or where they are and where they're going. That often answers the exact same question, that if I can show them, hey, listen, by our strategies, I can get you to live within here and really be comfortable for that period of time, including all of these increases. Well, I can make that happen. Well, then you can retire today. And it's more common the case that when I'm dealing with somebody, I show them a path of retiring earlier than they had projected. So I really don't come across a lot of people that come away from a meeting saying, well, I don't have enough and I'm somehow, I'm in a bad situation, I'm screwed. What we often will say is, I didn't know that was possible. I didn't know I had that much, or this is what it could do. And I think we're probably in a similar situation, you and I, where we're often giving people good news that say, this is how you will be okay. The answer is you're going to be okay, and this is how it's going to happen. And it can probably happen a little bit sooner than you thought. And so now the ball's in your court about when to decide how to do it.
Now, with people that do have enough, a common problem is the psychological and emotional aspect of actually spending something they've spent 40 years building. Do you have any tips, tricks, or approaches to help people get over that hurdle and actually spend their money?
Yeah, we do. Actually, we talk about helping people lead great lives in retirement. So when we build out our model, we actually have what we call a great life spend. And so what we do is say, we've taken care of what you thought where your budget was going to be. This is what you can live on. And here's an amount that you can set fire to every year. for the next 30 years. That great life spend, we want you to go and allocate that to leading a great life. And of course, it's going to be different for every client, but it does get them over the emotional hurdle when we can show that this is coming out on a regular basis and they're still okay. And I think part of our obligation on reviews and in conversation with them and checking in and even having the clients share back what they're doing to lead great lives is to hold them accountable to that and say, listen, this was allocated for it. What did you spend it on this year? Oh, I didn't take it off. Oh, great. What are we going to spend it on this year? Like, what are we going to do? And I know that it's working when I get clients parroting it back to me. And one of the sources of pride that I had most recently is I had a client come in, recently joined, let's say in July, and by September was asking me, hey, when can I get some of that great life money? Because I need to put a deposit on this cruise where I'm going. I was like, right, it's landing for you. You understand. And so when we were able to kind of do that, really putting it into the plan as an element of what success looks like is that it is spent, and then making it linked to what they define as a great life, I think is the thing that helps our clients kind of overcome that emotional hurdle, actually spending something and still understanding that there's going to be something left for their kids. I mean, I know a lot of clients will say, I've given them enough already. I want the last check to bounce. But I know in reality, they do care about what they leave behind. So if we can show them that what they're going to be leaving behind is going to be okay for them, and they can spend something else, all the better.
Good, yeah. And for the other clients who don't quite have enough, or they present to you what they have and you tell them their options and their options don't jive with what they're hoping you'd say, how do you work with them, or what do you say? I think you sort of touched on this, work longer, save more, what have you, but anything else you would do to help people modify their expectations of what they have, what their stuff can do?
Yeah, Andy, I think there are a couple of things that people can do who are a little bit on the edge of not being okay. The first one is that to the extent their health permits them, see retirement as something other than going from 100 to 0. So having some form of transition period. There was a recent client of ours where there was a school teacher and somebody that worked in corporate America, and the school teacher wanted to retire. But if they retired with 0 income, even with the pension, it wasn't really going to work. So what we said is, well, what if you retired from that to go do this? And as long as this looked like an extra $2,500 a month, you were making a half-time salary for part-time work, actually, we can get you to be where you needed to be, where you need to be off of it. And so I think that introducing a perspective of retirement that isn't complete cessation of all of their work activity is one of the ways that we can get that through there. And also having them understand that they can make a different decision about what their spending looks like on an ongoing basis. So if we're looking at guardrail spending, if we're looking at saying this is high, low, there can be a period of time where we have out-earned what the budget looks like, and all of a sudden it has shifted and increased. And now we can lock in something that might be higher over time. So it may be a not yet decision as opposed to a complete no.
Right. That's a good point. All right. Now, in wrapping here, if you can give only one piece of advice or word of wisdom to listeners about retirement planning, what would it be? And note this is directed towards consumers, not other advisors who are listening.
Oh, I got all kinds of advice for other advisors, but fine. We'll go with the advice towards the.
We'll save that for another show. Yeah.
That's the after dark version of it.
Yes,
special
right.
subscriber for paid.
Like the B-roll or whatever they call it. Yeah.
I think one of the things that's most important is that you're going to be defined more in your retirement by the things that you went and did, and less about the finances. The retirement planning component is the initial part because you're concerned about security. You want to make sure that you're okay, and I get it. But if that's the only thing that you're focused on, you're going to end up losing so much time and experience in what you were able to do, and looking back and figuring out what the definition of success looks like. So the best thing you can do is offload that work. I mean, we have a vested interest in advisors to essentially encourage you to come and work with someone like that. But I think that the best of us believe that you are materially better for hiring us, not just in the sense of what you could accomplish in the area of finances, but what it will free you to do in the rest of your life. And so focus on the other elements of it. There hasn't been the Wells Fargo, truck that goes into the ground with them, as I've seen, right? It's all kind of going to be left behind. So what will you be taking with you? What will you be leaving behind? It's going to be defined about more than money, beyond what the finance is. And to the extent that you start to focus on that, you'll probably be happier overall. And that's where I would like to encourage people to be.
Here. I agree. And finally, where can people go to find out more about you, your firm, your like I said, your prolific content sources?
Well, the two things that I'm most excited about, I can certainly give our web address for our law firm, which I'll do in a second, but we have revamped that Make It Last podcast with a new name and a new focus. And so if people want to get information about more than just finance, but want to look at the entire retirement spectrum, we're spending a lot of time with our show called Retirees, and it's on at retireesradio.com. So it's RETIREASE radio. So Retirees Radio. And then certainly if you'd like to learn more about me, I'm at palantewealth.com. That's PALANTE wealth.com. And by the way, that name that we've chosen is actually a contraction that's used in my heritage. I'm Puerto Rican by birth, and so we use the phrase palante. And palante is actually a little contraction with a little apostrophe, and there's two words together, and it's really about looking forward. It's a phrase that we use with one another, and it's I like that it's linked to my heritage, but a lot of people ask the question, why palante? One, it's easy for you to pronounce as it being a Spanish word that you can figure out how you can see it, but the other element is it's really part and parcel of how we help our clients lead great lives.
Great, thank you. And I'll be sure to link all these things in the notes to this episode so people can easily access them. Well, Victor, this was great. I was not let down. This was everything I expected and then some. So thank you for coming on and sharing your time and wisdom. It's greatly appreciated.
Hey, thank you so much for having me on, Andy. This was fantastic.
Yep. All right. Thank you, everyone. Take care.